What's up, Wealth Nation? Today we are talking about indexed investing for beginners. My name is Carmen.
And I'm Darius. And the conversation we want to have is, how do I go from zero to millionaire investing in index? Now, the conversation is going to be as if we have no clue what we're talking about. So what we did is we brought on Mr. Michael Jones, who is an expert at investing, in a very passionate individual who wants to grow his online community so that we can all just start having conversations about investing.
Now, let me give you a little bit of background story first before we bring Michael on, because Michael is another brother of ours inside the group app community, where we are both building communities to educate the public as far as financial literacy goes. So he has a take on investing. We have, as far as stocks are concerned, we have a take on infinite banking as far as life insurance is concerned. So we figured that we should bring our two communities together and just continue to share so that we can continue to educate more people. So Mr. Michael, welcome to our channel, sir.
Hello, glad to be here.
Awesome. So do me a favor, give us your 30-second elevator speech. Who are you, and rep what you're talking about?
My name is Michael Jones, and I am from the Pittsburgh area. As you guys have alluded to, I am very passionate about investing, and I want to be able to build a community where people aren't intimidated by investing in the stock market. So I'm glad that I'm able to talk with you guys about that, and hopefully I can, get a few more people on board to start investing in themselves, because we're already putting our money into companies that we help make billions of dollars per year. So why not, grow with them in the process?
You said a lot.
Oh, man.
That's a hell of an elevator speech. you applause for that. So you said like three things I want to touch on. First one, you were talking about investing in yourself, which I think is huge, because a lot of times people confuse, I would say, investing in themselves with actual investing. Mm-hmm. And what I mean by that is investing in yourself, taking time to educate before you start swiping or spending any money, because you can get in trouble with regardless of what capacity of any financial products that you get involved with. So educating yourself was one takeaway that I got from your intro.
Yeah, and just to add on to that, the issue we have when it comes to risk is the fact that we haven't taken the time to educate ourselves to help us be able to identify a good opportunity versus a bad one. Mm-hmm. So investing in yourself, huge.
Absolutely. And then the other point you mentioned, where we're already spending the money anyway with these companies. Go figure. As consumers, we are spending billions, if not trillions of dollars every single year on just the little frivolous things that we think bring us joy. So why not? What were you going to say?
Well, only thing I was going to say is we're talking about how we're able to invest in these companies and make them billions of dollars. How can I invest and become a millionaire just from investing with these companies? How
do I go from a zero to hero? So that's what we're going to talk about on today's call. So basically, Michael, let's just get started from the ground floor, right? Let's assume that we have absolutely no education from the stock market is concerned. We have no idea what's going on. So how would you approach us and tell us, like, this is how you get started?
Right.
So what I would usually do to get started is finding a brokerage that works for you. Okay. So you have brokerages like Robinhood, which is probably one of the most popular, Public, M1 Finance, and Webull, amongst others. Mm-hmm. But I would say my personal picks for beginners would probably be between Robinhood or Public, because they're much more user-friendly and they give you the information about particular stocks in a digestible way. So that's where I would get started.
Got it. Okay, so that's good to know. So then, why would someone and let's take a step back, because we just went straight into how will we get started. What is the draw to investing in the stock market?
That's a very interesting question. I think it would be the potential returns that you can get as opposed to leaving your money in the bank. A lot of people, when they think about investing in the stock market, they're intimidated because you hear all of these things about the stock market going down and things like that. Historically, the stock market goes up, and if you think about putting your money into the bank where you get maybe a less than 1% return per year annually. Yep. Ironically, if you were to invest in a bank stock, you would get a much better return. And so I want people to be able to realize that the companies or banks that they're actually frequenting, you can get a better return over the course of time.
Okay.
That makes sense. And that's something that we talk about all the time on the Wealth Nation channel, is understanding where you're putting your money and how you can make your money work for you.
Now, one question I have is, help me understand the level of control that an individual may have when investing in the stock market. Is it, if you have, let's say I got $5,000, will that give me some control over how I'm able to leverage those funds by investing it in the stock market? Or is it better for me to invest in something like a index, which will give me more of a variety, or where I can invest in multiple companies versus just a few of them that I pick out? Which will give me the most control?
I would say indexes for sure, because you're diversifying your portfolio. You do have the autonomy when going into these brokerages like Robinhood or Public, where you can buy individual stocks. But if you go into an individual investment, while the return can be much higher than an index fund, it's also riskier. So when you're
Got it.
going into an index, diversifying your portfolio is much better, because you're not depending on the success of one particular stock. So I think you would definitely have a lot more control, and you increase your chances of success in going into an index fund.
Yeah. Well, you know what? Let me back up, Smarty Pants, because what's an index fund? Remember, we're beginners.
Oh, okay.
So essentially, an index fund is a like a basket of stocks that follow a particular index. So, for example, there is an index that has 500 of the biggest companies in the U.S. And so, an index fund like a company, or an index called VOO, or an index called SPY, that consists of the 500 companies within that the initial index of 500 companies that it follows. And so when you're doing that, again, you're investing in that particular index. You're investing in companies like Apple and Amazon and Facebook and 400 other companies all at the same time. So you're increasing your chances of success in the stock market.
Got it. That's a good way to think about it. So, and you all both kind of alluded to this, where it might be opportunistic for you to invest in an index fund rather than an individual stock because of the diversification, so to speak. However, what we also want to do, so something that we mentioned on the Wealth Nation channel, is when we talk about diversification, it's not always about putting your eggs in one basket. So just because you invest in the stock market, that doesn't necessarily mean that your asset classes are diverse. You have to spread things around and making sure that you have assets, and you have money parked in different assets so that you're truly diversified. But within the stock market, for example, and Michael, correct me if I'm wrong, is you want to be able to spread your money around and make sure that you have the best option, or the best play possible, and not just putting your money into one stock, for example.
Right, and that's what the index gives us, but we're still invested in a similar asset.
Yeah.
We still have the same asset class, basically, is what you're saying.
Yeah, exactly. And I say that because, and Michael, I don't know if people come to you about this, but we get it all the time where people are like, oh, I'm diversified. My portfolio is diversified. And we're like, okay, what are you in? The stock market. What else? You got real estate? Do you have any crypto? You have something else going on? So I just want to make sure that we're all on the same page, because we're teaching, right? This is a teaching moment. You have to make sure that you spread your money around.
Yeah. Now, if we're just talking about index, how do I go from not knowing to what's the first thing that I should read in order to educate myself on the next move? Like, before I get a Robinhood account, what information do you recommend that I read so that I can at least get a better understanding of some of the lingo that I may come across when looking at Robinhood?
And any content, read, watch.
Any content.
So for me, aside from getting the information from the brokerage itself, because like I said, apps like Robinhood and Public, they do have information about those like particular stocks or ETFs or index funds. You can go to a site like Yahoo Finance. Just doing your general due diligence on what you're thinking about investing in, without overwhelming yourself. And I think that that's one of the biggest things, is because there's an influx of information that's out there. People don't know exactly where to start. So maybe if you find one or two sites that you can go to that are reputable, that way you can give yourself an opportunity to focus on, what ETF or index or particular stock that you're thinking about investing in, and then sort of going from there and making sure that you're also not just throwing all of your money into the stock market without necessarily knowing what you're putting your money into.
Right.
So figuring out what your risk tolerance is and things like that when it comes to, investing, I think are very important. So due diligence, without going to 100 different sources would definitely be helpful.
Got it.
Help me understand a little more risk tolerance. When you say risk tolerance, break that down a little bit more for me.
So I think that when you touched on investing in index funds, I think that's a perfect way for someone to test their risk tolerance, and here's why. Because when you're investing in the index that I spoken on that tracks the largest 500 companies in the U.S. It has a history of growing 10% annually, right? So that'll definitely test whether or not you're able to handle the volatility, which is the swings of a particular stock. So if you feel like you're not able to handle a swing going in either direction, then going into an individual stock, maybe like a Tesla, which is a very popular stock, would not be for you. But maybe going into a stock like Coca-Cola, which doesn't move very much, that's not a very volatile stock. So you're able to sort of, I guess, gauge whether or not you're able to handle things like that. So I can't necessarily give someone, the blueprint as to what their own risk tolerance is because it's subjective. But I think as you get a little bit more acclimated to the stock market with consistent investing, you'll soon figure that out yourself.
Got it.
Yeah. Now, I wanted to back up something that I realized just from the conversation that we're having. And again, going back to the beginner piece of things is when I invest in the stock market, like what am I actually doing? When I transfer money to Robinhood, to whatever, like what's actually happening? You know what I mean? Because I think that's really what the intimidation that you mentioned in your intro, how people get intimidated just because they don't understand what's happening, what's going on. So if I send $5,000 over to Robinhood or to any brokerage, what's happening in the background? You know what I mean?
So I would say, when you're investing your money into Robinhood, Public, M1 Finance, you're basically investing in owning, pieces or slices of a company.
Exactly.
So I think the intimidation part that you had talked about is the fact that they're afraid that if there's a possibility of them losing their entire investment. So for me, I guess sort of scaling it back is that even if you do put your $5,000 into your account, you aren't necessarily automatically investing in the stock market. The account itself is holding your money, and it equates to buying power. And then you choose which stocks or index funds you would like to invest in.
Absolutely.
And so I would say over the course of time, you may be, if you put that theoretical $5,000 in, maybe you can start with $100 in one index fund, $100 in another, just to sort of build up your tolerance for market volatility and things like that.
Okay.
Good to know. Thank you for sharing that. Because just going back to, and I'm kind of putting myself back in those shoes when I was just starting to learn about the stock market and just other opportunities of investing. I understood real estate because I could see it. I could touch it. There was like tangible pieces there. But for me, when it comes to graphs and charts, I'm like, ugh, for me, that's me, Darius, all over it. But I think it's important for everyone to just educate themselves and understand exactly what's happening, what they're getting involved in. And when you have the opportunity to invest in a company, to own a piece of that company, I think the game changes once you start understanding like, oh, okay, I can do this.
Yeah. And honestly, people get afraid of stuff that they don't
understand.
They don't understand.
That's what fear is.
Yeah, that's all it is.
Yeah. So anything else that you want to cover, Michael? We have several more questions, but was there anything just from our conversation that you feel that we should touch on?
So one of the things that I did want to add when it comes to online brokerages is more recently, maybe within the past 5 or 6 years, thanks to Robinhood, there is commission-free trading.
Mm.
And what a lot of people don't realize is that, because we have that luxury now, is that brokerages made billions of dollars just from charging us to buy and sell stocks. And so now that Robinhood has changed the game for a lot of these brokerages, they were actually forced to go commission free, which makes investing easier, like easier now more than ever. And on top of that, something called fractional shares or share slices, where you don't have to buy outright an entire stock. So, for example, Amazon is worth over $3,000 per share. About 5 years ago, you couldn't buy, a slice of an Amazon share. You'd have to buy the entire share itself. But where share slices makes investing more convenient and easier is that you can have at least $1 to invest in a company and build your position over time. So that way you'll eventually hold an entire share of whatever stock you like to invest in.
Absolutely. Thank you for sharing that. And, let's talk about that a little bit, because I know that that's another thing that we touch on, which is don't give up control of your money. You need to make sure that you understand what's happening, and don't just give your money over to a brokerage, for example, and let them rack up on you. So what do you think? Why do you think Robinhood really changed the game? Obviously, because of the commissions piece, but do you think that the public really wanted to have more control, wanted to know what was going on, or do you feel like they just blew up the spot of showing all these brokerages how they were just literally collecting millions, billions of dollars from consumers?
So I think since Robinhood maybe 5 or 6 years ago was newer in the game, compared to TD Ameritrade or E-Trade, they had to do something that was different, something that was fresh, something that would attract new customers. And so when you talk about commission-free trading, which that could be, I think when I started my E-Trade account back in 2017, I was paying, I think, around $6 for every trade that I made, right? So you figure, like, if I can save $6, on every trade, buy and sell, like, that's very attractive, because then over the course of time, you're realizing that the money that you're paying in commissions, you would actually be putting into your stocks without having to pay anything else.
Go figure. Yeah.
So with Robinhood changing the game in that aspect, it forced those other brokerages, again, who were making billions of dollars, to go commissionless. And so I think that that's sort of what changed the game, and it allowed more people to find the stock market less intimidating and less confusing and cheaper to invest.
And they have, for lack of a better word, direct access in the sense of that they don't have to go to this fancy brokerage and have the discussions about what it is. There's apps on your phone now, and you can directly trade if you want to. Now, don't get me wrong. I know people are probably going to blow me up in the comments. I understand everyone should be paid a fair wage. Absolutely, I'm not blowing up the spot of brokerages, but just bringing to account that whenever you are investing, you have to make sure that you understand the fees that are associated with it. And sometimes, I know with life insurance, people don't understand the fees with life insurance. People don't understand the fees with getting involved with any brokerage, real estate, whatever it is. You just gotta know what's going on in the background, because every penny that you give up, it could be going away from you, when all you need to do is educate yourself a little bit more and go, oh, wait a second, I can park this $6 somewhere else.
Yeah, like Robinhood, who don't charge you any fees anymore.
Yeah. So then how do companies like Robinhood, who are commission free, make money now?
So there was something that happened earlier this year with GameStop and AMC and the whole meme stock bonanza. And so what we really found out is that they technically do make money on the back end through a third party, but it's pennies on the dollar. So I think that if I'm not mistaken, so I'll have to go back and do my due diligence on that. But from what I can remember, Robinhood did go to court over that because of transparency issues, right? So I guess because maybe the fees were so small that it was able to be omitted. But again, I'd have to go back into that. But I believe that there are very small commissions that are being made through the buying and selling of a stock. It's just so small that it doesn't even register.
Got
Got it.
Yeah, that makes sense.
Oh, cool. Now, what I really want to talk about is what steps do I need to take to turn my $5,000, $10,000 into $1 million?
Okay, so I would say consistent investing. So even though you might put $10,000 into an index fund and you can let it sit, of course that's going to accumulate compound interest over the course of time, which
Mm-hmm.
is interest on top of interest. It would be much better for you to have that initial investment and then keep investing consistently, whether it be $100 per month, $200 per month over the course of maybe 20 or 30 years. That's the best way that you'll get a return on your investment.
So
It's a long game.
would it be better advice for some people to take, let's say, the amount of money they're putting into a retirement account and put it into an index fund instead?
I would say it would depend on the potential returns. So, for
Gotcha.
example, if you're investing in the index that tracks the top 500 companies in the U.S., that has an average annual return of 10%. So, if that average return is better than putting it into a retirement account, then I would say go for that. But
Right.
it would be subjective, and it would be based on your risk tolerance in terms of your investing.
Got it.
That makes sense. And the other thing to note, and I'm glad that we brought this up, is when you invest in the stock market, you have to understand that this should be a long-term play. And I think what happens with people that they get involved, they get bored or they get discouraged because they see market trends, things are changing. They can't keep track, whatever it is, then they pull out. And then they blame, the market. And well, what would you just say to that individual?
A lot of things. so it's I'm glad that you brought that up, because this is a conversation that I have probably on a weekly basis. And I think now more than ever, because we're getting speculative stocks that are surging 200, 300% over the course of a week. A lot of people, it becomes desirable for people to say, screw the fundamentals, I'm going to take my chances on that stock. But then what ends up happening is that, one, the people who don't know what their risk tolerance is, they'll just buy into a stock, like a penny stock that may be $3. And because it surged from 50 cents to $3, like that's a big surge, right? So they think like, well, it's still cheap, so it has more room to run. So they might put $500 to $1,000 on it. But then that particular speculative stock might crash 50%. And so then they lose 50% of their investment, and then they panic sell. And so then they're like, screw the stock market, I'm over it. And so one of the things that I tell people is that while these speculative surges, they look very desirable because the returns are more than what's the typical 10% return annually would be. And so you're thinking like, if I can 10x my money in a week, why invest in an index fund?
True.
But you're taking an exponential risk when you do that, because there a lot of the times these speculative stocks that rise, they have no fundamental reason for doing so other than the fact that people are buying in. And then something called FOMO, which is the fear of missing out, sets in, where you have more people who are on the sidelines seeing other people turn $1,000 into $100,000, and they're like, I want in on that. But then when they're not doing their due diligence or doing the necessary research need be to actually make an informed decision, they'll just throw their money into it, they'll lose their money, and then they kind of get intimidated by going back into the stock market. So what I would say is, make sure that you are actually doing your due diligence when you're going into the stock market, and try not to let the feeling of FOMO, the fear of missing out, consume you, because a lot of the times you will get burnt, and the stock market does have a a harsh way of humbling people if you're not doing it safely.
Nice. So I would say the common theme I'm hearing is figure out a strategy, stick to that strategy, and don't let anyone around you deter you from the strategy that you have.
Absolutely.
and just be consistent with it.
Absolutely.
Yeah, and like you said, FOMO can play a big play. It can be a big piece in this.
It's a big piece in it.
Of
A lot of
everything
things.
of life, and it really can distract you. And shiny object syndrome is real. So you have to make sure that you go back to your vision and your values, and make sure that you hone in on what it is what purpose it is that you're investing in with any means that you get involved in. So Michael, one thing that I would say that we get a lot is when people come to us, they're like, well, the market, we're getting over 10%, and understanding the differences between averages and actuals is very important. So if I want to be successful in any investing that I do, especially when it involves the stock market, how can I position myself to get maximum returns?
It all comes back to risk tolerance. And the reason why I say that is because you can get a consistent return on an index fund of 10%.
Mm-hmm.
And the index fund that I always keep coming back to is the one that tracks the top 500 companies in the United States. And the reason why I say that is because since the 1920s, it has an average of 10%. So you figure it would be easier to predict your success in the future with that 10% return.
Mm-hmm.
But if you have a higher risk tolerance, then maybe you want to invest in individual stocks, which may be a little bit more volatile, but the chance for success could be exponential. So I'll give you an example. So 5 years ago, or at least if you were to invest in Apple stock 5 years ago, like let's say $1,000, that $1,000 would net you $4,000 because of a 400% return. But a lot of people, maybe, especially if you're a new investor and you don't know what your risk tolerance is, you may not be able to handle Apple's volatility because it fluctuates throughout the years. And so you might have several months where Apple stock is in the red. And so then if you can't handle that, you might end up panic selling. But if you have a higher risk tolerance, you're able to withstand Apple's volatility to get a higher return than you would from an index fund that tracks the largest 500 companies. So again, it all really depends on you. I would say personally, for me, I do both. So I invest in both index funds and individual stocks. So that way I'm dabbling in consistency, but also getting those exponential gains.
Perfect. That's going to be another question. What are you investing in? What would be the next question? So what I would say, going back to returns and things like that, I know one thing that we talk about with what we do with infinite banking is we feel like a lot of people sometimes confuse banking and investing. And at least the platform or the stance that we're coming from is if you want to keep your money in the bank, at least at the bare minimum, put it inside of a whole life insurance policy so that you can get guaranteed returns. And then from that, take those funds and then start investing so that you can use your funds multiple times. So the reason really why we brought Michael on the channel, obviously because he's very knowledgeable, he's very charismatic, and he's a friend of ours. But we want you all to see the differences between banking and investing. The foundations that we're talking about is paying yourself first, making sure that you're maximizing the income that is coming to you, so that you can then turn around and do something with that income.
So you think you can then invest it.
Exactly. So when you think about money, when you think about what are your options, what it is that you want to do, at the bare minimum, make sure that you're protecting yourself. And you got to protect yourself by making sure that you understand what your savings is doing, and that you can compound your savings. Why not make your money work for you? And Michael had alluded to the fact of earning compound interest inside the stock market. Make sure you understand that the compound interest is interest on top of interest, but it's interest that you're not touching. Right? You can't be picking at the stocks and moving money around thinking that you're going to get some sort of return. Your money has to sit. In order for compound interest to work, your money has to sit. That's why a lot of people aren't so successful or as successful as they want to, because they're constantly liquidating funds, and that money is now no longer earning the compound interest. So just little things that you need to think about before you get involved, because sometimes we get distracted, especially with our attention spans these days.
Sometimes.
What's the attention span of adults now? Like
a goldfish.
6 seconds.
6 seconds.
Something like that. So, and honestly, I just feel I worry sometimes for individuals who want to get involved in the stock market, just because we know their attention span or the shiny object syndrome, and that can totally derail whatever it is that you're trying to do if you can't stay focused on one thing at a time.
Yeah, well, I think a lot of times what happens is people want the results yesterday without having to put in the work. And anytime you want to be successful at anything, you have to put in the work. Like even when it comes to our favorite sports figures, the Steelers, for example, like we see them on Sunday, but we don't see them during the week when they're conditioning, they're in the weight room, they're doing drills, they're doing practices.
They're away from their family. They're
away from their families. They're sacrificing, and that's what it takes. Even Jeff Bezos, Warren Buffett, Bill Gates, these uber successful people, they sacrificed a lot in order to educate themselves and the practice and the time to be able to run these major companies. And if we scale it back to us, you have to put in the work in order to get the results that you want. There's no overnight success. It takes 15 years to be an overnight success.
Yeah, to add, I think you guys hit the nail on the head with that, because when you do see those rare cases where the success is microwave, that's where the fear of missing out comes in.
Yeah.
And so, I follow, for my own self, because it's entertainment, people who become millionaires from investing in speculative stocks or cryptocurrencies.
Yeah.
And so that will inspire people, and I use inspire very loosely, to go into these speculative assets thinking that their success will be microwaved as well. And then that's where you end up losing a lot of money. So actually, one thing that I wanted to add to what Carmen was saying about being worried that people may not have the attention span to do that because they may constantly, liquidate their investments, so they're not getting anywhere, is I would encourage people, after they get acclimated to Robinhood or Public, to download an M1 Finance account. And it's very boring, but I love it. and it's because you can only do 2 things per day. You can only make 2 trades per day. So that way, when the stock market is down, you're not doing reactionary buying and selling to make up for your portfolio being red. And you can only do the trades at 9:30 when the market opens, and 3 o'clock, an hour before the market closes, at least Eastern Standard Time. So for me, that's exactly what I do. Is I maybe put in $250 every 2 weeks, and it just automatically comes out of my account. I get the notification from M1 Finance saying that my investment has been spread around to the stocks and index funds that I'm investing in, and then I go on about my day and don't worry about it. So that's what I would do, especially if you're an impulsive person, because that way you're not, again, impulsively invest or buying and selling based on what market trends are and things like that.
Right. So $500 a month, $6,000 a year, you're investing in the stock market. You're doing the steady approach. You have your strategy worked out. You do a little bit in index, and you do a little bit in the speculative stocks. Perfect. Now, tell me a little bit about your community. If I'm brand new to investing and I want to be surrounded by like-minded people, tell me what I can expect from your community.
So what you can expect from my community is people from all investing journeys. Most of them, though, are newer to investing. So a lot of them will have questions about what they should invest in. How much should they invest, and things like that. And so what I'm doing is I'm building a community of investors, not only to depend on me for information, but to encourage each other to do their own due diligence, to make informed decisions. My group that I'm building is a group based on information and knowledge. What I try to do to differentiate myself from other groups is I don't just want to give you the answers, because then you're not thinking for yourself. I want to put information out there based on what I know, and I'm not the end all be all. So there's something that you can cross reference that I'm saying that you're just like, why did my research on that and it conflicts with what you're saying, and then we can have a discussion. And that's what I want to be able to do for my community is create that while consistently investing in ourselves. So
beautiful. No, beautiful. That's one of the reasons why we resonate so much with you, Michael, is because for us, it's always about putting the education in our clients and potential clients' hands so that they can make informed decisions. Because as we always say, no one's going to work your money harder than you.
Right.
So I think it's beautiful that you're building a community of like-minded people that can all come together and empower one another instead of always having to rely on someone to tell them what they should be doing.
Right.
Like you said, they need to think for themselves.
Absolutely.
So go ahead, give us a plug. What's the name of your community and where can everyone find you?
So the name of the community is called Marathon Investing and Trading, and you can find it through the Group app platform.
Fantastic.
Nice.
We'll link everything in the description below, and also shout out to Group App, brand new membership community where creators can come together and share all of the knowledge and continue to work with like-minded individuals, share and explore and then learn together. So we're excited to also have our membership on the Group App platform as well, so everyone can continue to learn together and come up.
Yeah.
Awesome. So Michael, are there any closing remarks that you would like to leave our viewers, sir?
No, I think that you guys asked some excellent questions, and I'm just hoping from this engagement between the three of us that there will be people who are inspired to invest and join our communities.
Absolutely. Nice. Thank you, Michael.
Thank you so much.
All right, Wealth Nation. So if you want to continue to learn how to make your money work for you, then definitely check out our next video where we talk about passive income. And remember, ladies and gentlemen, to own your own lifestyle.
Or someone else will.